Hi, this is Alan Rigg with SalesCompensationStore.com. In this video, I'm going to discuss whether you should calculate commissions based upon revenue, gross margin, or some other number. It makes sense to use revenue when your salespeople don't have much latitude for negotiating price. So if your salespeople work from a fixed price schedule, or if they have to come to you for any adjustment to price, then you may as well pay them based upon revenue because the calculations are easier. With that said, if your salespeople do have significant latitude for negotiating price, then it makes sense to pay them on gross margin or some other number. Gross margin, for the purposes of this discussion, is simply revenue minus direct cost of sales. And the reason it makes sense to pay salespeople based upon this number is because it motivates them to generate the highest margin possible while still winning the business. So it puts them in the same boat with an oar in their hand, just like you. They've got the same objectives you do, maximizing the profitability of each transaction. Another way to provide additional incentive when paying on gross margin is to consider the use of sliding scales. This means that you determine what the average gross margin percentage should be for some category of products or services, and then when salespeople sell at that level, they earn 100% of their commission multiplier. If they can increase the gross margin percent above the target gross margin percentage, they can earn a higher commission multiplier. By the same token, if they sell at a lower gross margin percentage, they earn a lower multiplier. Examples of sliding scales are provided in the free information that's available on the Sales Compensation Store website. The next option to consider is paying on a number other than revenue or gross margin. This normally happens if there are significant expenses that salespeople control, that's a very important point, that impact the profitability of transactions. So let's say perhaps that there are travel expenses involved in winning business, and salespeople can differentiate how much they travel and how much their expenses are while traveling. If that's a significant element for your company, you may want to deduct travel expenses prior to calculating the margin number to use for commissions. But the real important point, once again, if we have additional things being deducted from gross margin, is the salespeople have to have control over those numbers. If they don't have control, it'll be very demotivating for them to have their commissions impacted by something that, once again, they can't control. Another option you may want to consider is having some type of commission kickers to foster certain kinds of activity. Maybe you want salespeople to focus on selling a new product or service or higher margin products and services. Maybe you want them to focus on more new business, which can be defined as either selling to brand new customers or selling additional products and services to existing customers. That's the end of the content for this video. In my next video, I'm going to talk about other incentives you may want to consider including in your sales compensation plan. I look forward to speaking with you again soon. Goodbye for now.